You hit it right on the head, Justin, which it really is a personal choice about the kind of company you want to build and the kind of life and sort of uh, energy and speed and all of these things that you want to have, and also how much risk you want to take. I mean, it's taking other people's money can be stressful, right? I mean, you have a board of directors who are made up of your investors, and you have to continually show progress and answer to those demands. And so, there are pros and cons. And I think from a VC back standpoint, I think some of those key benefits are speed. When you raise money, it allows you just to go faster in every way. You can use that money to go hire really, really accomplished, amazing people who are expensive. You can use that money to build your solution and your product ahead maybe of where the market demand is. And so it just gives you the ability to sort of move faster. I think along with that, speed can result in true disruption, right? Like if you have an idea or a business concept that is truly innovative and disruptive, you need to take advantage of that market opportunity really quickly. And we just talked about speed. So if you want to take advantage quickly, really leaning in from an investment standpoint can be super important.
Yeah, and then on the flip side of that, so yeah, completely losing on speed, right? I was always, and we talked about this in a couple of our talks. Like, I think the way to think of it is Rob was always doing top-down planning, right? He's like, hey, I've got, pick a number, $5-10 million in the bank from the latest round. So we have a plan we've got to present to the board, and we're going to go ahead. We're going to go spend all that money to this outcome. I was doing the exact opposite. I was like, I'm going to have a deal that may or may not close in a month. And when that closes, do I spend that dollar on sales? Do I spend it on operations? Do I on engineering? Rob's moving all the levers up, and I'm choosing which lever I'm going to go. So that kind of top versus bottom planning results in speed. But on the flip side, it also results in control, right? So I had all the optionality and control that I could have ever wanted. I chose the exit ramp. Frankly, had I been VC funded and hit COVID and we hit some stumbles on the business, I probably couldn't have sold, because the exit wouldn't have been big enough for the investors. They would have wanted to take more risk. Let's work through this and go. And maybe that works out and you get a much bigger outcome, or maybe it doesn't and it goes to zero. And I got to the point where I had a bunch of off ramps that probably wouldn't have been available to VC, including cash flowing the company, right? So I had years where I just cash flowed the company and, built this lovely bunker and had money along the way and wasn't quite as all in as you might be, in the VC world.
Yeah, control goes out the window the second you raise somebody else's using somebody else's money. And I mean absolute control. I mean, you have a board of directors that really govern the business, and there are certain expectations, and you have to align on the speed at which you're going to grow the company, where you spend the money. And so, that optionality and that control really, really is one of the downsides of raising venture.